Insurance. Right. It's that thing you pay for month after month just hoping you never actually have to use it. It's a peculiar product. I mean, think about it. You're essentially betting against yourself. I bet my house won't burn down. But here's some cash, just in case it does. A truly optimistic pessimism. Now these companies, the ones taking your bets, they need to be stable. They need to prove they can pay up when a rogue squirrel burns down your shed, or so they claim. That's where financial reporting comes in. Dry, yes, but important. Terribly important. It's how companies show their homework, their financial health, or sometimes their creative accounting skills. We see you. So, picture the world. Accountants everywhere, speaking different languages, financially at least. Then came IFRS, International Financial Reporting Standards, a noble attempt at a universal tongue. Then specifically for insurance, along came IFRS 4. Its grand purpose? To bring some order to the chaotic world of insurance accounting. A world previously resembling a free-for-all buffet. IFRS 4 was meant to be the grown-up, the standard that would make insurers worldwide report things a bit more consistently. So you could theoretically compare apples with apples, but here's the kicker. IFRS 4 was, from day one, a temporary solution, a stopgap, a placeholder, like that temporary job you had for 5 years. It was phase 1, phase 2 took its sweet time. Now what exactly is an insurance contract under these fancy rules? It's not just any old pinky promise, you see. It has to involve something called significant insurance risk. Thrilling. Significant insurance risk. What does that mean? It means the insurer takes on a real risk, a risk from you, the policyholder. The chance they might actually have to pay. Think car insurance, you pay your premium. If you prang your car, the insurer pays out, hopefully more than you paid in. That's a transfer of risk. Your gym membership? Probably not insurance. So, if a contract doesn't pass this test, this significant insurance risk threshold, it's not an insurance contract. It might be a financial instrument, or a very elaborate savings plan. Fun. Alright, let's talk about recognition. In the world of insurance, this is a big deal. When does an insurer officially log a contract? When does it become real for their financial statements? When does it hit their books and start affecting the numbers that matter to investors and regulators? Usually it's when they're stuck with it, when the insurer can't back out anymore. That's the moment they're legally bound by its terms, and the obligations become real. Or sometimes it's when you owe them money, like when the first premium is paid. Now, measurement. This is where IFRS 4 got interesting and honestly a bit controversial. And by interesting, I mean, let's face it, a bit of a cop-out for global standards. Instead of setting strict new rules, IFRS 4 largely allowed companies to keep using their existing local accounting practices. Yes, you heard that right. No big global overhaul, just keep doing what you were doing. This meant that an insurer in, say, Germany could measure its contracts very differently from one in Japan or Canada. The numbers just didn't line up. So much for that global comparability dream. Investors hoping for clarity were left scratching their heads. It was a start, but a very slow start. Almost like the industry was waiting for something better. IFRS 4 did introduce some minimums though. One key requirement was the liability adequacy test. A fancy way of asking a very practical question: have you actually got enough cash set aside for future claims? Are you prepared for what's coming? It's a basic but absolutely necessary question for any insurer hoping to stay in business. So if IFRS 4 didn't fully standardize the numbers themselves, what did it do? It cranked up the requirements for disclosures. Big time. Basically, if your math is weird, at least explain your weird math. Companies had to spill more information about the amounts they reported from insurance contracts, and crucially, the nature and extent of the risks they were juggling. All those potential payouts. This meant insurers had to lay out their accounting policies, how they calculate what they owe policyholders, the assumptions they make, like predicting how many people will claim. Good luck. They also had to show how sensitive their profits and losses were to changes in those crystal ball assumptions. What if interest rates wobble? What if a new plague hits? Transparency, or trying to achieve it? The IFRS 4 was introduced way back in 2004. It was a time when the world of insurance accounting was in desperate need of some order, and the industry was grappling with a confusing mix of local rules and practices. The introduction of IFRS 4 was seen as a significant step, but it was never meant to be the final answer. It was always billed as Phase 1. The first step in a much bigger journey toward a comprehensive global standard. A quick fix, a band-aid. Something to hold things together while the real work was being done behind the scenes. While the accounting gurus toiled away on Phase 2, the real standard. Why temporary? Because the world needed a solution, but a permanent one was still years away. Because insurance accounting was a global patchwork. Every country had its own way of doing things, making comparisons nearly impossible. A mess of different rules. No two countries seemed to agree, and the result was chaos for multinational insurers and investors alike. IFRS 4 was damage control. It was about stopping the situation from spiraling even further out of control. It stopped things from getting even more diverse, and introduced some basics. It set a foundation, a common ground, even if it was a little shaky. The main change it brought? It made sure that, at the very least, everyone was speaking the same language when it came to disclosures. It forced a minimum level of disclosure, everywhere. No matter how different the underlying rules were, transparency was now non-negotiable, and it prevented countries from inventing new and even more wonderfully unique local insurance accounting rules. A small mercy, perhaps. It put a stop to the endless creativity in local standards. But that Phase 2, which became IFRS 17, took an eternity. Years turned into more than a decade as the world waited for the real solution. So, IFRS 4, the temporary guest, ended up staying for dinner. It became a fixture, not just a placeholder, and breakfast, and lunch. It lingered through countless meetings, audits, and financial statements, for well over a decade. Quite the extended visit. IFRS 4's legacy is a reminder of how even a temporary fix can shape an entire industry for years to come. Okay, let's be honest. Accounting standards. Just the words alone are enough to make most people's eyes glaze over. They're not the kind of thing you'd bring up at a dinner party, unless you wanted to clear the room. They're not exactly headline-grabbing stuff. Most people, even in business, would rather talk about almost anything else. But IFRS 4, bless its temporary cotton socks, mattered. It was more than just another rule book. It was a sign that the world was finally paying attention to how insurance companies reported their numbers. It was a crucial, if flawed, first step. A baby step. But every journey, even the most complicated, has to start somewhere. It aimed to make insurance company finances a little less opaque, a little more understandable. Across the globe, regulators and investors were desperate for clarity, and IFRS 4 tried to deliver just that. For companies, it meant new systems, more explaining. Suddenly, insurers had to rethink how they presented their business to the world, and that was no small feat. For investors, slightly better clues. Not perfect, but at least a step toward understanding what was really going on behind those dense annual reports. Understanding IFRS 4, even now it's historical, helps you grasp the sheer complexity of insurance, those long-term promises, those uncertain future events, the challenge of predicting the unpredictable and putting a value on it. Trying to put a number on that, it's genuinely tough. The math is hard, the assumptions are harder, and the stakes are enormous. IFRS 4 paved the way. It highlighted the problems, it forced the conversation, it made people realize just how much work was left to do. Now its successor, IFRS 17, is here to do the heavy lifting. The new standard is more robust, more demanding, and aims to finally bring real transparency. But IFRS 4 was the standard that got the ball rolling. Without it, we wouldn't be where we are today, and for that, we should probably grudgingly thank it, even if it made us all suffer a little along the way.